Hello, everyone. We are now all the way into Chapter 8. Adding to our complexity, um, we are going to deal with rental property and royalties, as well as income from flow through entities, S corporations, partnerships, that sort of thing. So, we're dealing with Form 1040, Schedule 1, and Schedule E, as it says on our title page here. So, getting right into it, it's important to remember that we've learned about depreciation in earlier chapters, chapter 6, and that's going to apply to rental properties. We're talking about commercial or uh, residential rental properties for the most part. We're talking about real estate, and so we're going to use that information about depreciation that we've already learned. So make sure that you have that handy as you work through and look at the things we're talking about in Chapter 8. So, Schedule E looks an awful lot like the Schedule C in that it kind of has the income and then expenses. However, it has multiple place for multiple properties. So you don't have to have a Schedule E for each rental property. You can put up to 3 rental properties on one Schedule E because a lot of people have multiple properties. If you have more than 3, then you need to create additional Schedule E's. So the first thing is, of course, expenses to the rental property are deductible. Okay, and the same definition for a business as they're ordinary and necessary. If there's a rental that is partially rental and partially something else, literally we treat it like 2 different properties and just separate, but based on either square footage or some other measure of size or expenses that help us to divide it. So often you can live in one side of a duplex and rent the other, and so you've got a 50-50 split, assuming that you have a way to split things like utilities. Maybe there's a separate meter, then you would use that. If not, then you could allocate 50-50 some of those expenses that apply to both sides. And that's really an important point in rental properties, and really any property that can be is got 2 uses, whether it be a business property from back in Chapter 6 that's used half business and half personal, and do the same idea. You really treat it almost like 2 different properties. So things that you might end up paying for: advertising, repairs, and maintenance. You pay someone to manage it, they collect the rent for you, that sort of thing. And then, of course, the all-important depreciation, which, of course, is the one that kind of trips us up because it requires the extra calculations. So 27 and a half or 39 years, you got 27 and a half years for residential, 39 for commercial property. So you can use the tables. If you have furniture that is rented, so you rent a furnished apartment, it has bed, it has tables, it has that sort of thing, is deducted, it depreciated for 5 years. Okay, that part that's for the furniture. Appliances, same idea, can be separately depreciated from the actual physical building if you choose. So refer back to Chapter 6 for the tables that you need. Now, if it reaches the level of a business, meaning, and this is very specific in the tax law, you have to material participate. So the assumption is that rental properties are not a business, and therefore have specific restrictions. But if they are, they have to qualify to become a rental real estate business and then move to the Schedule C. You have to material participate in the rental activity, and you're considered a real estate professional. And right, so it has to be more than 750 hours. If you're and more than half of all of your activities. So you really have to do it kind of almost full time. If you have a full-time job, it's going to be hard to qualify as a real estate professional. All right, but certainly if you track your hours, things like that, and have a real estate license and some of those other things, it would have an indication that you are in a real estate business, and it's scheduled, should be reported on Schedule C. Okay, little thing to remember: if the tenant pays you instead of rental payment, let's say you have a tenant who owes you paying $800 a month for rent. Say there is a repair and you don't get to it quick enough, and they hire somebody to do that repair on your behalf, and they pay that person $400 and then only pay you $400 in rent. You still have income of a full $800 as the landlord because you received that repair they did on your behalf. Okay, so you have income. Now you also have an expense, okay, of $400. So it's not because you're not any better off. You got they have the income, and then you have the expense offset it. Okay, so all right. So when you have vacation homes, so this is not where, say, half of the building is rental and half of it is personal. This is where the whole building is used, but at different points of time during the year. And so to try to simplify these vacation home kind of rules, and that's kind of what we're talking about, we classify these vacation home situations as either primarily rental, primarily personal, or personal rental, kind of a mix. And obviously we're almost always dealing with residential property. This doesn't really apply to commercial property. You wouldn't live in it or rent out your commercial property for the weekends for vacation people or something like that. So, but this is also a much bigger issue now that we have Airbnb and VRBO and all of these other ways that you can rent out your home sometimes while you're there, but also when you're not there, and for people at a week at a time or a couple of days at a time. And so these have become even more common situations than they were before because of that. And so it becomes even more important to know how to divide up into these three categories. So you're looking at it based on how many rental use days compared to your personal use days. Okay? So you're looking at this example. He uses it for Christmas for 7 days. He rented it for 90 days. The rest of the time it sits vacant, okay, in this situation. So this is primarily a rental property. You see far more days for renting than for his vacation, okay? So we need to qualify what is the personal use of the home. So obviously if you're renting it out, that's the rental use. But what is personal use? This is where the tax rules give us a little, are more particular, because this is where more likely people are going to abuse or look at things differently than the IRS is. Okay? So if you use it, or your family, or if you let somebody else use it free of charge. Okay, so if somebody else, your cousin goes and stays there and doesn't pay, then that is personal use, even though you weren't there. All right. Now, even if it's a family member, and this applies even if they're not a family, it's just your coworker uses your beach house. Okay, that is personal use if they don't pay. If they are a family member, even if they pay the fair market value, it's still personal use. So even if they pay you rent, You're so stingy that when your brother goes to stay at your beach house, you actually make them pay the regular rate you charge everybody else. That doesn't matter unless they are going to. And this exception is very narrow. Unless they are using it as their primary home. Let's say your brother is, lost his job and is in some bad situation and needs a place, and so you decide to let him live at the place and still charge him rent, and they're using it for their main home and moves everybody in. It's not just for temporary. Then it could be not personal use, but for the most part, this is a broad definition. Okay. However, the exception is, and this is the one that smart homeowners will take advantage of, time spent working on the property doing repairs is not considered personal use. So you go to the beach house and you make improvements. You replace a window. You do that kind of thing to the house. There's no necessarily rules about how much of the time. It just needs to be the reason why you went there, that sort of thing. So there is that kind of, you might say, loophole or consideration in personal use definition. So how does something become primarily a rental? Okay, so here is the exact definition. Okay, no more than 14 days for personal use or 10% of the total rental days, whichever is greater. All right, so that is primary rental. So this is considered incidental personal use, no more than 14 days or 10% of the rental days, whichever is greater. So if you had a lot of rental days, you could use it for more than 14 days personally. Okay, but that means you're going to have to rent it out for, say, 150 days, and that's somewhat hard in these situations. Okay, if that's the case, if it's primarily a rental house, everything is reported on Schedule E. You still have to allocate between personal and rental use. So even though your personal use was very small, and it's that small amount of your expenses cannot be utilized against the income for the rental. All right. However, if the expenses are greater than your income, there is the opportunity to report a loss up to $25,000 on this property if that was the case, and your income isn't too high, and that phases out between incomes of $100,000 and $150,000. So if your income's over $150,000, you still may not be able to report this as a loss, even if your expenses are greater, and you only utilize it. And you'll see on the Schedule E that you are actually answering questions about how many days were rented, how many days were used personally, so that they can check on you, might say, that you classified it correctly. Okay? So still has to be allocated, remember that, but it is reported, the ones that are for the rental part by Schedule E, and you're allocating it based on the number of days. Okay, so example, renter 190 days for 36,000, use it for 17. Primary rental, 10% of the day, 190 days is 19. Okay, so she would take her expenses and she would allocate them to the rental based on 190 divided by 207. And her personal would be the 17 divided by 207. See how those fractions allocate the costs. All right, home that is rented less than 15 days is primarily, okay, a personal property. All right, and this is a nice little benefit if you rent for less than 15 days. Doesn't matter how much the rental amount is, how much you get for it. Okay, you don't have to report it. Okay, it's just we just kind of say it's not enough to worry about. However, you don't get to deduct any expenses either, okay? Except for those that might be taxes and interest on the property. Under, and we'll learn about in Schedule A that we learned about in Chapter 5. Okay, so that mortgage interest property taxes could be deductible as an itemized deduction, but not on the Schedule E. And we'll end with an example. This rented their cabin in Big Bear for $2,000 for 10 days over the holidays. So if that was the only rental you had, you can use it. You used it for the rest of the year. It was not rented again. Then it is primary personal. You get that $2,000 tax free. You might say you got to receive it, and you don't have to include it in income.